a spike in U.S. interest rates, which makes the debt less serviceable, but also increases the probability that you have some form of credit control or quantitative easing, both of which are good for gold. The bottom line is I'm completely sanguine about the gold market and about gold prices. In fact, I'm delighted to see the weakness for this reason. Although I did sell 80% of my silver, I have sold no gold, and I was looking to buy more gold. I thought $5,500 was a bit stiff. Not stiff enough that I would sell mine, but stiff enough that I wanted to see the gold price decline so that I could buy more gold. And I have recently bought a little more gold, precisely what I wanted to do. So the weakness in the gold price, given my long-term outlook for gold, was useful for me.
The current state of the precious metals market reflects a growing imbalance between long-term fundamentals and short-term investor behavior. While prices have shown volatility and hesitation, the underlying conditions suggest that the setup for a larger move is quietly strengthening beneath the surface. Rickrule, a seasoned resource investor and capital allocator, emphasizes that the real opportunity in markets like gold and silver often appears when sentiment is weakest. He points out that despite strong macro drivers, rising debt, persistent inflation pressures, and monetary uncertainty, investor participation in the sector remains surprisingly low. This disconnect creates the kind of environment where value builds unnoticed. In his framework, markets reward patience, not urgency. When capital is scarce in a sector with improving fundamentals, it often signals the early stages of a longer-term opportunity rather than the end of a cycle. Now, we present the clips from Rickrule's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
People express their fears, and often when people express fears, they buy gold. Systemic moves in gold, though, aren't a consequence of geopolitical fears, unless the geopolitics gets really out of hand. Gold moves because people have a specific fear, which is to say the deterioration of the purchasing power of their savings instruments, which is different than gold. The performance of gold in this conflict was very interesting, and I think it has to do with the fact that gold did its job. One consequence, short-term consequence of this conflagration was a strength in the US dollar. That strength in the US dollar happened both because people were disintermediating out of other currencies, in particular dirham, but also because rising interest rates paradoxically made the US dollar more attractive, even during a war, and gold is quoted in US dollar terms. A separate thing that happened is that some countries in the world needed liquidity. Turkey, in particular, among them, had to liquidate 60 tons worth of gold to defend the Turkish lira against depreciation in US dollar terms, which would have raised domestic prices in Turkey. The fact that gold was liquid meant that the Turks were able to sell their gold, raise the liquidity in periods of time when they couldn't sell lira-denominated bonds on world markets. So paradoxically, gold's weakness was evidence of gold's utility. Looking further, we have to pay for this war. What will happen as a consequence of that is that the U.S. budget deficit is almost sure to blow out from $2 trillion to $2.5 trillion. That cannot be good for the strength of the U.S. dollar over time. The second thing that happened is, of course, a spike in U.S. interest rates, which makes the debt less serviceable, but also increases the probability that you have some form of credit control or quantitative easing, both of which are good for gold. The bottom line is I'm completely sanguine about the gold market and about gold prices. In fact, I'm delighted to see the weakness for this reason. Although I did sell 80% of my silver, I have sold no gold, and I was looking to buy more gold. I thought $5,500 was a bit stiff. Not stiff enough that I would sell mine, but stiff enough that I wanted to see the gold price decline so that I could buy more gold. And I have recently bought a little more gold, precisely what I wanted to do. So the weakness in the gold price, given my long-term outlook for gold, was useful for me. The volatility reduces fees, reduces commissions. They think of risk very differently than you do. Wall Street's financial parameter is the quarterly cash bonuses that the individuals working for the firm generate from fees and commissions. To the extent that volatility yields unhappy customers, unhappy speculators, and reduces their access to fee income, volatility is risky. For me, volatility is just a series of sales. If I have an opinion as to something's value, the fact that it fairly frequently falls below my estimate of value and then fairly frequently exceeds my estimate of value means that perversely for me, volatility equals liquidity. I realize that I look at things very differently. There was a point in time at Sprott where I was much more reliant on investor flows for my well-being. Now I'm down to one client. His name is rickrule. And that's allowed me to look at volatility as an opportunity as opposed to a risk. It's funny that you bring that up. I've been involved with Diablios, that project, for 25 years. I helped acquire it for Silver Standard. I owned the predecessor to Abra. And yes, I absolutely looked at the whole. First of all, the whole has, as you suggest, stunning numbers. But that's not what's important about the whole. The thing that's important about the whole is that it points out the mineral endowment of that camp. This isn't a deposit. This is a series of deposits. And this is a deposit with different deposit styles and signatures. This is a multi-phase deposit, which means that during its formation, during the epoch, if you will, in which the minerals got imprinted, that they got imprinted through many, many, many pulses. This multi-phase impregnation, multi-pulse orogenesis, is the signature of important mining districts. It isn't just the fact that there's 20-gram gold or the extraordinary mineralization in this hole. It's the different style of mineralization that we're seeing here relative to the styles that we've seen in other parts of the camp that excites me. Don't get me wrong. Having this thing start from surface, if you get any sort of dimension on it at all, yields you an extraordinary starter pit. Your net present values go absolutely crazy if you pay out the mine in a year as opposed to pay out the mine in 3 years. So I'm not discounting the impact of having that sort of graded surface. But what really excites me is what it teaches us about the potential orogenesis of the deposit and the ability of the deposit to grow markedly in size and style. It depends on for who. I have Abra as a 4, which is an extremely high ranking for a speculative stock. I think we're at the part now where they understand enough about the origin of the deposit that exploration is becoming predictive. And in my life, very frequently when that happened, I remember back as an example to Hemlo or Arequipa or some others, when that circumstances occurs, inventory grows very rapidly. And I'm expecting that we're going to see that happen at Abra. I could easily be wrong. It could be that for the last 18 months, they've been lucky as opposed to smart. I have known that geologist all the way back to the days when he worked for Ross Beatty. He's a very high quality guy.
From a deeper perspective, the market is not yet in a phase of widespread enthusiasm, which is typically when major tops form. Instead, what is being observed is a lack of conviction, particularly in mining equities and silver, which historically lag before catching up in stronger bull phases. This suggests that the current environment may still be part of a broader accumulation phase. Investors are cautious, capital flows are limited, and narratives remain mixed, all characteristics of a market that has not yet reached its full potential. If demand begins to return, especially from institutional or larger pools of capital, the move could accelerate quickly due to the relatively small size of the sector. The imbalance between supply constraints and future demand expectations continues to build. In that context, the next phase may not be gradual, it could be sharp, driven by a sudden shift in sentiment and capital allocation toward tangible assets. Let's get back to the interview.
What do we need to know about copper? Well, first of all, we have underinvested in copper, Jordan, almost for your entire lifetime. We've underinvested in copper for 30 years. This is a capital-intensive cyclical business. You don't cure 30 years of sin in 5 years. Right now, we have a deficit in copper production, which is to say we use more than we produce. but production will inexorably decline. There's nothing we can do about the decline in copper production for the next 5 years. Absolutely nothing. So we're already at a deficit, and production's going to decline. At Metals Week, pardon me, in London, end of last year, I heard a paper that was really the genesis of the copper boot camp, where they said that the major mining companies in the world, in order to maintain production at its current level, understanding that the current level is at a deficit, will need to invest 250 billion 2025 constant dollars. They also said that the inputs for construction and production were increasing in price at between 8 and 10% compounded a year, which means that $250 billion compounds at 8% over 10 years. Further, they said that the industry had a line of sight to 150 of the $250 billion, a missing $100 billion. And then the kicker, demand for copper is growing at 2% compounded. So we have to spend 250 billion, 100 billion of which we don't have, to maintain current output, which is already at a deficit to current demand, and demand is increasing at 2% compounded. That's really all you need to know. At some point in time in the future, I don't know if it's 4 years out, 5 years out, 6 years out, you have to ration copper by price. There's nothing that you can do to increase supply. Yes, markets will work a little bit, but it's important to note the utility that copper has. There's 400 pounds of copper in a car, an electric vehicle. If you double the copper price, you change the finished price of the car by 5% or 6%. The utility around copper means that because the copper price has to rise and because it can rise because of its utility, that it will rise. Meanwhile, there's all kinds of cool investment ramifications. There's all kinds of things we can teach around this that will allow people to take advantage of this. As an example, one place that the money to build copper mines is going to come from is selling the gold and silver streams from the copper. Recent circumstance where Wheaton Precious, a much smaller company, in effect lent BHP. They didn't lend them. They bought BHP's gold silver stream from Antamina for $4.2 billion, points out the fact that byproduct precious metal streams in a copper wrapper are worth more as precious metal streams than they are as copper cash flows. You are going to see huge transactions take place in the royalty and streaming space as part of the capital stack in building copper mines. Irrespective of what the industry does, because we haven't explored for 30 years, we haven't found very much copper, the Lundins being a notable exception and Robert Friedland being a notable exception. The average mine grade for copper worldwide in your lifetime has fallen from 1.5 or 1.6% to 0.4%. We haven't found much copper because we haven't looked for much copper. What that means is that when you discover a high quality copper deposit, it's going to sell for absolutely eye-popping multiples. The third thing that we're going to teach is that although we do net present value calculations, a net present value calculation is flawed on a supergiant deposit. The reason for that is a net present value calculation eliminates any cash flow that you receive over 10 years. And that's not an incorrect way to allocate capital, but it negates the fact that a 40-year mine after 10 years restarts the net present value calculation at 100. The tails on these very, very, very long-lived deposits get no credit in the market. So we have a situation where the large companies with long-lived reserves are invariably and ironically accurately underpriced. We have a circumstance where in order to maintain production, the big companies, in addition to having to build mines, will have to buy projects that are too capital intensive for their existing owners in order to maintain production. And we have a circumstance where people who discover deposits, good deposits, and they will be discovered once we start looking, will be able to sell them for eye-popping multiples. For your listeners who aren't familiar with our boot camps, first of all, we have for about 4 years, every 90 days, done a deep dive into one topic or another around natural resource investing and speculating. We did a 3-part series on gold, we did silver, we did uranium, we did an area play one called the Golden Triangle. We did one on royalty and streaming. We did one on the capital stack. We've done a lot of things where we spend 8 hours in one day giving retail investors that are willing to work, because it's a lot of work, enough background that in conjunction with the free courses at the Rule Classroom, that those people can reasonably expect to become intelligent investors and speculators in a sector. It's a pretty good use of 8 hours. Do not come to our boot camps if you're a tourist, if you're the kind of person who buys the Sunday papers to read the funnies. This is 8 hours of very hard work, and we'll give you access to the recordings, which you'll need because we give you more information in 8 hours than you can absorb in 8 hours. If you're easily bored, go play with your kids. Go somewhere else. This is really, really, really hard work. We are having a fireside chat with me asking Robert Friedland questions. Now, that's a risky endeavor. Robert often uses your question as a platform for a statement. But spending time listening to Robert Friedland has proved to be a consistently very good use of my time for the last 40 years. I also need to say, if you come to the Copper Boot Camp and you think for any reason that isn't worth the money I charge you to come, I'll give you your money back. There's an absolute money back guarantee. I've done that for 30 years. I'm delighted to say that we've had to refund about 0.1% of the tuitions that we've charged over 30 years. But that money back guarantee is your guarantee that we are confident in the content that we distribute to you.
Looking forward, the potential outcomes hinge on how capital flows evolve in the coming months. If the current undervaluation relative to broader financial assets begins to correct, gold could push significantly higher over time, particularly as investors seek alternatives to increasingly unstable monetary systems. While precise targets remain uncertain, the historical pattern suggests that once a bull market in precious metals gains traction, it often exceeds expectations. Silver, as a smaller and more volatile market, could outperform gold in percentage terms during a sustained rally. This creates the possibility of outsized gains, especially if industrial demand and investment demand begin to align. Mining equities, often the most leveraged play on metals prices, could also see substantial upside if margins expand alongside rising prices. At the same time, the path higher is unlikely to be smooth. Volatility, corrections, and sentiment swings are part of the process. The key theme remains positioning ahead of broader recognition rather than reacting after the move is underway. Share your thoughts in the comments below. If you found this valuable, make sure to like, subscribe, and turn on notifications so you don't miss our future updates.